And what's happening, options traders? Happy Monday, everyone. And I was doing a coaching session earlier this weekend, and one of the traders said that he got this unexpected pattern day trader margin call. So what's this all about? Well, I thought it would be a good thing to pass on especially for a lot of the new traders in this group who might inadvertently step into a day trader margin call. And what does that mean, and why can it cause some problems? So to first understand, you have to realize that there is FINRA, the Financial Industry Regulatory Authority, and they're the industry watchdog for the stock market. And back in 1974, they created a $2,000 minimum equity for a margin account. And that still holds today. But the idea then was that it was more for buy and hold investors. But then when 2000 came along and the internet, we started to see a lot of online brokerage firms, and day trading became a fairly popular style of trading. A lot more online brokers and tools to do it. And so after the 2000 crash, FINRA said, well, it posed a lot of risks to not only traders, but to the industry. So they created the pattern day trader rule in 2001. And again, the idea was to protect brokers and markets by requiring higher balances when you're engaged in day trading. You see, if you've got kind of a regular account or buy and hold, and you get some adverse market conditions, you've got some assets in the account that the broker can sell to meet those deficits. But if you are a true day trader and you're flat at the end of the day, there's nothing in there to sell. So FINRA said we really need to make sure that there's enough equity if people are day trading. So which trades count? Well, really, any day trade counts. So, like the name implies, if you buy and sell on the same day, or if you short and cover on the same day, sometimes what we call a round trip. It's done in the same day, and that is a day trade. So anything that you're used to trading, stocks, options, ETFs, ETNs, all of those will count. Now, interestingly, futures and Forex don't count. So if you're trading currencies, E-minis, anything like that, or even options on futures, they do not count towards this day trade count. The reason that these don't count is that futures and Forex are regulated by the National Futures Association, or the NFA. So they're similar to FINRA for the stock market, but the NFA just simply doesn't have any rules for day trading. Now, another thing you have to be aware of is that stop orders count. So this is another area where traders get hung up, and they'll say, well, I bought these shares planning to hold them for 10 years, and I placed a stop underneath them just for protection. You get some market volatility, you get stopped out, and it's a day trade. So it doesn't really matter what your intentions were. If you are in and out in the same day, it's a day trade. Now, just to clarify, if you put a buy order in at the market close and you sell it on the opening bell, doesn't count. That's not in the same day. So the pattern day trader rule applies only to margin accounts. So if you're trading in a cash account, which you can't be if you're trading options, it's got to be in a margin account. But for those of you who might be trading stocks just in a cash account, it does not apply. However, keep in mind that in a cash account, you do have the free ride and liquidation violations. And I do have other videos in here on those as well. But the pattern day trader, only to margin accounts. And what it says is that if you have 4 or more day trades in a 5 business day period, you're considered a patterned day trader, or a PDT. Now, the exception is if those day trades are 6% or less of the total trades during that same 5-day period. So let's say that you placed $10,000 worth of trades in that 5-day window, but $600 or less were actually in and out in the same day, were true day trades. They're not going to ding you on that. They'll let that slide. They're just saying that's not really a significant portion of your trading. But here's where traders get stuck. If your account ends up getting tagged with its PDT label, you must have $25,000 equity in the account. Also keep in mind that brokers can make any rule stricter, not just within PDT, but for anything. So if you think that you might be heading into a pattern day trader, or just never want to have that restriction of requiring 25,000 equity, you might want to check with your broker to see what their rules are. They might say, oh, if you're 5% or less, we're going to classify you as a pattern day trader. Or if you do 3 or more day trades in a 5 business day period, they are allowed to do that. So if your account gets labeled as a pattern day trader, are there any benefits to it? Well, yes, a pattern day trader account may trade 4 times what's called the maintenance margin excess as of the close of the previous business day. If you're not familiar with those accounting terms and what cash available and things like that, there's another video in here called Margin Account Basics that will explain it. But you can trade up to 4 times the maintenance margin excess. If you have a regular margin account, you can only trade 2 times. So there is a benefit to it. So keep in mind that if you are a pattern day trader and your equity falls below $25,000, you are back to being restricted to 2 times the maintenance margin excess. So how do you get into a pattern day trader account, and how do you meet it if you get issued this margin call? Well, what's going to happen is that your broker will issue a day trading margin call. So if you've got $10,000 equity in the account, you now have to have $25,000. They're going to give you a $15,000 margin call. And you need to meet that with either cash or securities. And you have 5 business days to meet that margin call, unlike traditional margin calls that are technically due immediately. Also, cross guarantees aren't allowed. So you can't say, here's a brokerage statement from another broker, or even at the same firm, that shows I've got a different account with more than enough money into it. Those are called cross guarantees. The cash and the equity has to be in the account where the day trading is taking place. Now, another interesting point is that, let's say you deposit this $15,000 or whatever this margin call is, you may withdraw it after 2 business days. So FINRA is really just trying to make sure that traders have the financial wherewithal to meet it in the event, that they end up with some bad losses in there. So you don't necessarily have to hold it in there. But of course, if you withdraw it, then you're not going to get that 4 times excess benefit. Now, here's where it gets really dangerous. If you don't meet it, your account is restricted to trading on a cash basis for 90 days or until it's met. So again, if you go back to that video called Margin Account Basics, it talks about what a cash account is. So they're essentially going to be treating your margin account as a cash account, and that can really cause some problems. So how do you avoid them? Is to understand the rules and not get into them in the first place. So to help you keep track of where you are in that day trading count, a lot of the better brokers will track it for you and will show you where you are in that 5 business day period. So for instance, let's go over to the Thinkorswim platform and see how they track it. So in the Thinkorswim platform, they have this little, what's called a sidebar or a rail. I usually keep it hidden, but right down here, you see this little arrow? If you click there, this is the sidebar. And there's just some added information, and you can change these and configure them into all different things. But right up here at the top, here's your option buying power, Forex buying power, a lot of your margin terms that you need to know. And right here, net liquidating and day trades. And if you click there, there it is. Today, 0 day trades. Business day -1, 0. Business day -2, and so on. So there is the 5 business day rolling window. So if you see that you're getting close, you might want to either back away, not set stop orders in the same day, or perhaps trade futures, E-minis. But at least you know where you are in the count. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.